So the concept we want to talk about today is something called the four pillars. Today in Canada, there's basically four different tax environments where you can save your money. There's the RSP, something called non-registered, there's the tax-free savings account, and something we call the insured tax shelter. And we'll start by talking about the RSP. So do you have any experience with that? Okay, what would you say are the biggest reasons why people use that program? Yeah, that's right. There's tax deduction. A lot of people love getting that tax break every year. You can grow your investments tax deferred. And of course, it's for retirement, and it's just kind of what people know. Now, do you know anyone who's had to pull money out of an RSP? Yeah, so we have to pay tax when we go to pull that money out. So just kind of go through an example. Let's say we were to build up $1 million inside that program. And a lot of the programs nowadays, or a lot of the books tell us that, if you were to pull out 10% per year in your retirement, you won't deplete that too quickly because you do have that money still invested. So that would be $100,000. Now, what sort of tax bracket do you think you'd be if you were to pull $100,000 out of there? Yeah, it'd be pretty high. Um, if we're pulling out $100,000, we may not be in the top tax bracket, but pretty close. And the other thing about the RSP program, we may be deferring tax, but we're actually deferring it into an unknown tax bracket because we have no real idea what the government's going to do with our tax rules going forward. So if we were to say we were in a fairly high tax bracket, we'll say 40% today, we'd lose 40% taxation or $40,000, which would leave us with about $60,000 that we would get to spend. Okay, so not necessarily all that exciting, right? But like we said earlier, a lot of people just love getting that tax deduction. So let's say this person was putting away $5,000 per year into the RSP. If they're in that same 40% tax bracket, that means they're going to get a refund every year of $2,000. So if we were to do that for the next 20 years, that's total refunds of $40,000. So I don't know about you, but to me, I think $40,000 is a lot of money. And if the government was to show up on my doorstep with a check for $40,000, I'd probably take it. The only challenge I have with that is that they gave that back to us over 20 years. But now, once we're retired, how long does it take for them to make that money back? Yeah, it's just 1 year, right? So don't get me wrong, the RRSP is a great place to save money, but it's only as good as the programs we have in place to get those dollars out more tax effectively later on. Does that make sense? Okay. Any questions on that at all? Okay, great. So that's how the RRSP works. Next thing we want to talk about is the non-registered area. Do you have any experience with that at all? Okay, great. So there's a few different ways to make money in this area. We could make money through interest. So if we had money in things like GICs or bonds, we would get paid an interest rate. We could make money through dividends. So if we were invested in stocks and those companies happen to want to pay a dividend, if they do well, we can make money that way. And we can also make money through something called capital gains, which is kind of like where we like to focus the most because the tax treatment is probably the best in this area. So do you have a working understanding of how capital gains work? Okay, so this might be a little bit of a review, but let's say that over a period of time, you're to invest $100,000 of your own money. And over time, that grows to that same $1 million. So capital gain is just the difference between what we put in and what that money grows to. So in this scenario, we would have a capital gain of about $900,000. Okay, and that's important because we only pay tax on part of a capital gain, not all. So kind of how this works then is if we were to do the same thing and later on decide we're going to pull out $100,000, how the government looks at this, they say is there's a small portion of this 100,000 we pull out, which is from the original money we put in, which we never pay tax on again, and a lot of it is growth, which we pay some tax on. So just to keep it simple today, we're going to say that all of this $100,000 we're pulling out, it's all capital gains. So how it works in Canada today is we only pay tax on half of a capital gain. So what that means is the first $50,000 we get to put in our pocket tax free. The second $50,000 is going to be taxed, But because it's a smaller amount than, say the 100 we were talking about earlier, we should be in a lower tax bracket. But just to kind of keep it worst case, let's say we still pay 40% tax here. So that would work out to 20. So on this side, we're left with 30. So between the two sides here, left with about $80,000 that we get to spend. So now it becomes a bit of a trade-off, because what would you rather have? Would you rather have $80,000 a year to spend in your retirement, or $60,000 just so you can get a refund every year of $2,000? Yeah, so it really depends on the person. Yeah, so do you have any questions about that? Okay, so that's how the non-registered works. So let's talk a little bit about the tax-free savings account. Have you used that at all? Okay, great. So some of the main characteristics of this one, there's no tax deduction for putting into it. You grow your investments tax deferred. Now there are some contribution limits, and a lot of that is dictated by your age and whether you've been over the age of 18 since the day that it started. So it can be different for different people. But I've always kind of had a bit of an issue on what they name this program. They call it the tax-free savings account. And unfortunately, for a lot of people, they go to the banks looking for this product and they assume that they have to put it into a savings account. And so the reality is that to defer tax on such a small interest rate that they pay on a savings account doesn't really benefit. So the reality is that, and what people need to know about it, is they can invest in this in any number of things to get a much better rate of return. And that way they're going to get the max benefit through tax deferral. And one of the key points here is when you go to get that money later on, you're able to get that money and pay zero tax, which is very important. Okay, any quick questions on that one? All right. So the last one we're going to talk about here is what we call the insured tax shelter. Now this one's a little bit more complicated, but I'll do my best to try and explain it the first time through. So a few characteristics of this one. So again, there's no tax deduction to go into it. You grow your investments tax deferred. So that's basically like a lot of these other areas. It's like the RSP, it's like the tax-free savings account that way. And in most cases, the capital gains area, it's also tax deferred. Another key point here is it's creditor proof, any money you put in here. So, if somebody comes along and decides they're going to try and sue you to get at some of that money, they won't be able to touch any of this money. And the last one here is we can also use this money we built up in here as collateral to get loans or lines of credit, that sort of thing. So how this one works is that if we want to build up $1 million inside this program, we actually have to purchase a thin layer of insurance to wrap around this product. And really what it does is it just allows us to grow that money's tax deferred. And it makes it so the investment inside there is governed by a different set of tax law. It's now the Insurance Act instead of the Securities Act. But all that really means is that we create a barrier here where the government can't break through and tax this money as it grows. All right. Now, when we get to retirement and we decide we want to start using this money, if we pull that money right out of the program, there would be some tax implications. And as a general rule of thumb, it would kind of have us fall halfway in the middle here between RSP tax treatment and capital gains tax treatment. But there's a little bit of a different way to do that. So if we can, we want to eliminate that tax. So it kind of comes back to this characteristic here that we can use it as collateral. So we could actually take one of these programs and go to a bank and say, hey, we want to use this as security. We want to borrow against this program. Now, the banks would look at this and they actually see this as really, really good security, because in a lot of cases, it's actually safer than borrowing against real estate, those sorts of things. And one of the biggest reasons is, unfortunately, is that they know we're going to die one day. So what they're actually willing to do on these programs is they're actually willing to advance us up to 90% of this investment value as a line of credit or a series of loans, however we want to take that. So that would work out to, in this scenario, about 900,000. So let's say we get that set up and we decide, kind of using that 10% rule, let's say we're going to draw out $90,000 that first year. So what would be the tax implications of that? Yeah, it's a bit of a trick question, because technically we're using borrowed money now. So there's actually zero tax to pay on that. And so that means we're trying to maximize here how much we get to spend. So that allows us to spend that full $90,000, which is important. Now you're probably looking at this right now and saying that's probably too good to be true. There's always a catch, right? And so obviously the catch here is that because we are using borrowed money, they're going to charge us interest on that. And historically, what they charge on these programs is prime plus 1%. Now, prime is really low right now, but just for ease of calculation, let's say today that that number works out to 10%. So what that means is that in year two, for having used $90,000 the first year, they're going to charge us $9,000 in interest. So we probably look at this and say, well, that doesn't sound like such a great program anymore. And we may go to the banker and say, listen, we don't really like paying this interest. And of course, the bank's going to tell us, listen, that's what we do. That's how we make money. So we have to charge you that interest. But tell you what we will do, because we've got really good security here, what we're willing to do is capitalize the interest. And all that means is that they're going to charge us for the interest every year, but they're not going to make us pay it every year. They're just going to kind of keep track on the side of how much interest we owe, which initially doesn't sound like a good idea, but it actually works out to everyone's benefit in the end. And you may wonder, well, why are the banks willing to do this? And the reason is that if we pay this $9,000 per year of interest to the bank, technically that's income to the bank, and they would have to pay tax. So they're just like us. They want to defer interest and taxes as long as possible. So they go ahead and they let us capitalize that interest. And really what it allows us to do is to continue to spend the full $90,000 instead of $90,000 less interest. But sooner or later, we have to pay this money back. Now, technically, what the bank wants to do is they want to wait till the day we die. And the reason is that the insurance proceeds from one of these programs, because it's tied to insurance, it's paid out 100% tax-free. Okay, and that's important because what happens now is that the bank will now get back all of their money plus all the interest, and now they'll get it completely tax-free. It's good for us because it's allowed us to have a tax-free retirement income, but also once the bank is paid back, anything that's left over, we get to leave to our beneficiaries tax-free. And that's also important because if we compare that back to, say, the RSP, when we look at that program, when we pass away, we can roll that to a spouse or a dependent child one time tax-free. But when that second person passes away, depending on which province we live in, between income tax, probate fees, and legal fees, we can pay up to 52%. So basically the first day of retirement, we could come running out of the bank excited that we're retired, step off the curb, get hit by a bus, half that money's gone. If that happens to us over on this side here with the insurance tax shelter, that first day of retirement and something happens to us, all that money goes to our beneficiaries 100% tax-free because we haven't even used any of the borrowed money yet. Okay? So that's essentially how that one works. So just based on looking at that, where do you think you prefer to save your money? Yeah, that's kind of what we find is typically people really like the idea of the last two there, the tax-free savings account and the insurance tax shelter. But we also talk about diversification. I think we've all heard that when it comes to investments. Don't put all your eggs in one basket. Another thing we talk about is diversify by tax strategy. And what I mean by that is, if possible, is to have a little bit of money in all these areas. And one of the biggest reasons for that is that, again, we don't really know what the government's going to do with our tax rules in regards to these certain areas over time. So if we put all of our money in one area, if we put all our money in the RRSP area, and then later on the government decides that they're going to tax us at 60% coming out of there, if we're a couple of years away from retirement, there's nothing we can really do. But if we have our money kind of spread out in all of these different areas and they change the rules in just one area, it's really not going to affect us that much. Okay, so that's really what we want to look at doing.